Hi, I'm Brock.
I'm Jim.
Before we get started, if you want to stay ahead of the cattle markets, sign up for our free daily briefing at herdadvisor.com. It's delivered right to your inbox every morning, 5-minute read. And when you're ready to dial things in, the easiest way to add $300 per head is timing your sales right and choosing the right sale barn. That's what the Cattle Market Guide helps you do for just $75 a year, less than taking your wife out to dinner. Check it out at herdadvisor.com. Welcome back to another Friday wrap of the Cattle Market Guys podcast. I'm Brock, coming to you from snowy central Nebraska, and we've got a packed show to send y'all into the weekend a little smarter and hopefully a bit more prepared. Cattle prices, packing plant closures, tight supplies, muddy pens. It's the kind of week where producers are scanning everything from the futures board to the 14-day weather radar, just trying to make sense of where we're heading. Let's get into it.
And I'm Jim, still kicking in West Texas. This week's been like trying to push a rope uphill. Messy markets, weather messier, and prices all over the map.
Ha, that's about right. All right, let's kick it off with a look at the latest numbers. According to the data, average prices for 5 to 549 weight steers are sitting at around $370.97 per hundredweight. Compared to just a few weeks ago, that's a decent bump, and those midweight calves are leading the charge right now. Futures are showing some disconnect, though. The front month feeder cattle contract is coming in at $337.52, while next month's contract is a bit softer at $332. So while cash has been climbing, futures seem to be hesitating, likely reflecting concerns over shrinking demand or lingering production concerns. Now here's where it gets interesting. The national prediction for the next 1 to 4 weeks has prices continuing that upward trend. The 1 week outlook puts steers in that 500 to 549 pound range at $410.96 per hundredweight. By week 4, the forecast still holds strong, with prices hovering at $408.47. So the models are expecting continued strength as we move into January, even as futures reflect some caution. This kind of divergence always makes me pay closer attention. What's your take on that spread?
Well, these mixed signals remind me of a two-headed calf. You don't know which way it's going to turn. I've always said follow the cattle, not just the contracts.
That's the truth. And according to the latest article from the cattle site, the current strength we're seeing is mostly being chalked up to tight supplies. Packers are scrambling a bit to fill chains, and that's showing up in the wholesale beef prices too. So bottom line this week, cash prices are solid, futures are skittish, and short-term forecasts are bullish. Not a bad cocktail if you're looking to market gains heading into the new year. Now let's move to perhaps the most disruptive headline of the week, and that's the plant closures announced by the industry's biggest players. Tyson is shutting down its Lexington, Nebraska plant, effective January 20th. That's a facility employing about 3,200 workers. Meanwhile, their Amarillo, Texas location is being reduced to a single shift. On top of that, JBS is closing the Swift Beef operation in Riverside County, California come February 2nd. That one's a bit smaller but still significant, with 374 employees being laid off. This isn't just noise, this is structural. These are major players adjusting their long-term strategies. And for producers, particularly those marketing fats in proximity to those facilities, the impact could be felt immediately. It's not just a matter of longer haul times, but potentially lower bids, scheduling delays, and thinner local competition among buyers. You've seen this before, Jim. What's a move like this do to a local market?
Oh, Brock, I remember clear as day. Back in '98, IBP shut that big old plant up in West Point, Nebraska. Had something like 1,200 folks working the floor. Me and 3 other boys from out near Ogallala had to ship our steers 200 extra miles just to get them processed. Diesel was cheaper back then, sure, but even still, the margins got thinned out real quick.
Yeah, and that was back when the consolidation wave really kicked off, right? These closures coming now in 2025 are less about overcapacity and more about efficiency and maybe shifting demand patterns. But from the producer side, the lesson still applies. You've got to stay flexible because when the big packers start making moves, it ripples through the whole supply chain. Also worth noting, these closures are in different regions, Nebraska, California, Texas, which spreads out the impact. But it also shows how widespread restructuring might become. If you're relying on a single plant to move your cattle or getting squeezed by limited local kill capacity, this is the time to be checking your contracts, verifying your transportation options, and maybe even reevaluating your marketing calendar. And look, beyond just packer access, there's the employment side too. That's 3,200 families in Lexington, Nebraska, who are going into the holiday season with uncertain futures. That has downstream effects on rural economies, vet clinics, feed dealers, you name it. This is a livestock issue, sure, but it's also a community one. So don't just watch the kill numbers next month. Pay attention to how basis shifts regionally, how buyer behavior adjusts, and how your own position might need to evolve.
Rule number 1, never build your plan around just one packer. That's about as useful as a screen door on a submarine.
Well said. All right, shifting gears to our next topic, the fundamentals behind the recent price action. Let's talk about the underpinning strength we're seeing despite all this volatility. According to recent reports, cash cattle prices are currently sitting at $228, while dressed prices in the northern feed yards rose by $2 to $357. Not insignificant, especially this time of year when we often see softer demand post-holidays. The cattle site notes the rally in futures this past week was helped by tightening supply and technical buying interest. Wholesale beef prices are climbing too, which shows that the demand end, at least at the distributor and retail level, is holding firm. On top of that, packer interest seems to be shifting earlier in the week, likely to secure enough head before weather or logistical issues pinch their margins. All these factors combined suggest that the market has more strength than the futures boards have been pricing in recently. From what you're hearing, are feeders feeling confident or cautious with those kinds of moves?
Well, depends on who you're asking. Some of these fellas feel like the rug's been pulled enough times they're sitting on two legs of the chair. But yeah, folks around here are holding out for higher bids. That's how strong the pen talk has been lately.
That tracks with what we're seeing in the numbers. The futures got a boost earlier this week, but still haven't quite caught up to the firmness in the wholesale and cash markets. That kind of lag in futures pricing can be both a risk and an opportunity depending on how you're positioned. Another factor, mud. The reports this week highlight rough pen conditions in Nebraska feed yards. And let's be real, nothing slows down cattle movement and compromises weight gains like knee-deep slop in December. That's got packers making adjustments to their purchasing strategies as well. In other words, if margin pressure builds on the packer side because of weather, you might see more aggressive competition in the cash market, at least in the short term. Could be something to keep an eye on as we wrap up the year and head into January placements. And speaking of weather, that brings us to our last deep dive this episode, drought, cold snaps, and the ongoing tug of war between the eastern chill and western warmth. This week's drought monitor showed continued warm trends throughout the western states, while the east has been colder than normal. In the northwest, the Cascades and Rockies are getting hit with snow, which could help long-term water prospects, but isn't much help in the near term for producers operating at lower elevations. Closer to home, Nebraska hasn't just been cold. It's been muddy. Pen conditions across many yards are rough, and that has a direct impact on feed efficiency and market readiness. You get enough stuck loaders and off-weight cohorts, and suddenly your expected out date is a week or even two later than planned. I know weather's always played a big role in your decision making over the years, Jim. Does this week's situation remind you of anything?
Oh boy, does it ever. This reminds me of that hard drought back in '88. By July, our pastures down in Menard County looked like concrete, and the stock tanks ran drier than corn liquor. We had to liquidate nearly half the herd by mid-August, way earlier than normal. And the kicker was, everybody else was doing the same thing. The sale barn over in San Angelo had trailers backed up 2 miles long. Prices couldn't help but fall, 15 cents a pound lower than the year before.
Wow. That kind of involuntary movement will shift a market quick. And it's a lesson we keep relearning. Mother Nature doesn't care about your marketing calendar. If pen conditions degrade or storms roll through, you may lose your window for optimal pricing. On the West Coast, that heat isn't doing cow-calf guys many favors either. Dry soil profiles heading into winter can mean limited grass early in the spring. And while snowpack in the high elevations is welcome, runoff takes months to help pastures. So every region's watching a different set of variables, but they all boil down to access, be it feed, water, or favorable selling conditions. Bottom line, producers need to stay nimble. Weather-related delays in finishing could lead to tighter supplies in February and March, which in turn may support prices. But if the weather swings the other way and placements flood the pipeline, futures might start correcting downwards. If you're not already tracking the weather patterns 2 to 3 weeks out, now's the time to start. Could be the difference between hitting your grid or missing your premiums.
Ain't that the truth? Mother Nature's the only force that don't negotiate.
Definitely something to remember, especially with forecasts showing continued variability across key cattle states. All right, folks, that wraps up our Friday edition of the Cattle Market Guys podcast. We covered a lot: strong calf prices, futures that are lagging, beef plants shutting down, packers adjusting, and the weather doing what the weather does best: keep us honest. Looking ahead, all eyes are on how the packers manage reduced capacity, whether this cash market momentum holds through the holidays, and what January placement intentions might look like. Jim, any final thoughts for folks heading into the weekend?
Well, if I had a nickel for every time we said watch the weather and price talks, but basis walks, I could probably open my own processing plant. But seriously, now's the time to double check your risk plans for Q1. Keep your buyer relationships tight and don't lock in just because you're tired. There's still money to be made if you play it smart.
Wise words. Thanks as always to our listeners. We're grateful to be part of your weekly grind. Be sure to share this episode with your neighbors and give us a follow wherever you get your podcasts. We'll catch you next time on the Cattle Market Guys.
And remember, folks, winter's just getting started, but so are the opportunities. Keep your hay dry, your gates closed, and your mind open. Y'all be good now.
That's all for today. Remember to sign up for our free daily briefing at herdadvisor.com. And the easiest way to add $300 per head, timing your sales, and choosing the right sale barn is at herdadvisor.com with the Cattle Market Guide.
Catch you in a couple days.
All right, see you then.